Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Well, the 5-month stock market rally seems to have hit a bit of a roadblock here in the wake of a little worse than expected consumer sentiment reading back last week. Here to weigh in on that now, Editor-at-Large Steve Reitmeister, our senior market analyst Charles Rotblatt, and top market technician Kevin Matris. And this is the 17th of August, by the way, that we're taping this on, so that reference to last week, you can kind of put that in some context for yourself. But you've got some interesting data and an interesting take on this consumer sentiment story. That's where it all seems to be pointing right to the consumer now. Yeah,
and actually, if you flash back a few weeks ago when we talked about, what indicators are we going to be looking at, I think a couple of us talked about the consumer, here again being 70% of the U.S. economy, taking a look at either sentiment or retail numbers as being what the market's going to hinge upon going forward, and certainly that seems to be one of the things that's kind of stopping us here or creating pause in the market. So right. I'm going to put up here the numbers for the Consumer Sentiment Index. Now here again, when you just get a number, like here comes a headline number, boom, that the consumer sentiment is, what was it, 62 or something like that, and it was worse than expected. But here again, what's important on metrics like these is the trend. If you take a look at the far right, you'll see where that July number came in at, and unfortunately, it's worse than June and worse than May, and so that's 2 months in a row going in the wrong direction. This chart, as you'll see, has a history of being not terribly steady. So in other words, when that first June bit of information came in, it was lower, like, oh, this thing has a history of being sporadic, of being volatile, so let's see. So when there was a 2 months in a row of it now ticking down lower, that certainly was a concern for folks. Now add to it the earnings reports coming out from the retailers, Walmart and Kohl's last week. Yes, both beating expectations, but both talking about not a great consumer outlook. This week we'll get Target and a couple other retailers, and so there's definitely some concern here. So the U.S. consumer is 70% of the U.S. market, but an interesting statistic, the U.S. consumer is 20% of the world market. Mm-hmm. And that's why there was some great concern around the world and a bit of a sell-off in the world markets.
Right. Charles, what kind of emphasis do you place on this indicator when you're looking at the markets?
Well, I think you got to look at the broad trend and not worry about month to month. One thing we have seen, and I think both the Michigan and also the Conference Board surveys, is that people are worried about their jobs, and rightfully so. One of every 6 Americans is either unemployed or involuntarily working part-time, and that number is probably conservative. There's probably more. It doesn't factor in people who either have had their salaries cut or have taken a job for less salary than they were previously working. Right. So people are struggling. Today we saw from Capital One credit card delinquencies, the number of people who are 30 days late or more on their payments rose to 4.8%. People are struggling. We had more banks shuttered last week, 77 closed for the year. We're looking at home foreclosures rising. We're looking at mortgage delinquencies rising. We're looking at commercial real estate struggling. So when you put it all together, it's still a tough road ahead for the consumer, and it's going to affect things. And I think people who are expecting this sharp V-shaped recovery need to realize that the consumer doesn't have his home equity he can tap anymore. They're struggling with payments, and I think when you look at the CARS program, you're seeing a lot of purchases that might have occurred in 2010 or 2011 actually being shifted to right now. And when you look at all the trucks and the Ford Escape being bought, I think it's clear some of those people are people who are buying cars now because they know he can get a good deal versus people who feel confident about the jobs or actually think the economy is getting better and they're going to buy because they have better expectations about the economy.
Well, the cars deal, that's a whole different issue. There are dealers who haven't even seen the money yet from the federal government.
Right.
And so they have put a moratorium on any future sales until they see how that resolves itself. But concerns of a double dip recession, Kevin?
I don't have a concern right now of a double dip, but, as Steve had pointed out, the consumer sentiment numbers are going in the wrong direction. The retail sales numbers are going in the wrong direction. Now, I should put into context that consumer sentiment numbers prior to the dip we had seen in the last 2 months, they had been going up, I think, for the 4 or 5 months prior to that. Same thing with retail sales. Retail sales, in fact, the consumer was surprisingly strong earlier in the year, and that is, I think, what gave the market the confidence to move higher. But you know, the market had been expecting higher numbers for consumer sentiment. That went down, so completely the wrong direction. Same thing with retail sales. They were expecting a big increase. We saw a much larger decrease. So things seem to be going in the wrong direction at the moment for the consumer. But while that's happening, you have the Fed come out. They came out last week and they said that they are seeing signs of economic stabilization. Right. And then you also have industrial production going up and then manufacturing going up. In fact, in today's Empire State Manufacturing Survey, that came in more than twice as good as expected. Mm-hmm. So it's very weird because you have this divergence. You have business, which is finally starting to move forward. Even productivity is moving in the right direction, but then you have the consumer who is going in the wrong direction. So it is going to be imperative to be able to see both of those metrics move in the same direction to provide the next catalyst for an extension of this move.
So Charles, getting back to the stock market, is this a case of we've moved too far, too fast? I mean, in 5 months, 50% run up in the market?
Yes.
Okay, well, that settles that.
No, we have. I've been talking about this being a hot potato market, and that's what we're seeing. The economy is getting better. We're definitely seeing signs of stabilization, but as I've said before, the recovery is not going to feel like a recovery to many Americans. And a lot of people had priced in this V-shaped recovery, which it's not going to quite be a V-shaped recovery. It's going to be, you know, more gradual than that. And I do think when you look at volumes levels, it was a lot of fast money moving stocks up, and they were going for the stocks du jour versus really thinking, okay, what's truly going to benefit from this economy? And as a result, since things got a little overextended, we had a little news, really not bad news when you look at Japan, which seems to have fueled Monday's sell-off. It wasn't that the numbers were bad, it was just that GDP was about 0.2% lower than people thought, about 20 basis points, and that kind of triggered the global sell-off that we're seeing this morning. Mm-hmm. And I think some people are taking a step back, realizing, okay, we've had this huge gain. You know, where are we looking at the top part of what's reasonably expected given the growth that we're seeing? Even if you look at Q3 GDP of 3%, it's being fueled by cash for clunkers and some government programs. And I think people are starting to realize that, yeah, we're seeing growth, but we're coming off of lower levels. And what are we looking at for the next 6 to 12 months? And I think it's going to be a very slow pace of recovery. And we need to factor in a slow pace of recovery, not the sharp rebound that when you had look at the trajectory of stocks, what they had actually been signaling.
So slow pace of recovery in the economy means sideways market?
I think a prolonged trading range.
Okay. Kevin, what are the charts telling you?
You know, the first thing I want to say is, yeah, we have had a sharp recovery from the bottom that we were in, but we're only, I'm not sure if we're even on the year right now, but I mean, for all intents and purposes, give or take a couple of percent, we're kind of flat for the year. So I do think the market does have more room to move on the upside. What's interesting is I read an article today, I'm not sure who wrote it, but he said something like that we should ban the month of August because nothing good ever happens.
I've heard that about September.
Yeah, well, it's interesting because, you know, today is underscoring that point. September, yeah, September historically is a hallmark of poor things. October always seems to spook the market. So do I think everybody should abandon all hope? No. I do think that that the market is due for a correction. We're seeing that right now. Is this going to be the correction that sets the tone to be able to pull back and really collapse this bull market that we've been seeing? Nobody really knows, but my bet right now is that that is not the case. I do think that we can move higher, but if we see the indexes move in some sideways pattern, I still think there's going to be a lot of great opportunities. And I think the industrial sector, the manufacturing sector, the types of companies that will benefit from infrastructure plays and the stimulus, these are the areas that I am concentrating on right now. And I do think there's still opportunity in the marketplace.
All right, I don't want to get Steve in here. Tell me that we're not going to touch the March lows here.
No, I don't think that's even in the equation right now. I think this idea of the double dip recession, I don't think it's about, I'm not terribly worried about that. I think that the risk right now is that we just, here again, lay along bottom, okay, which has been established, let's say in the second quarter of the year. We just kind of stay at that level for another year or two. And if that's the case, then the idea of a trading range for which where we're at right now would be about the top end, and I think about 8,000 would be the bottom end. I mean, you could always like sneak into the 7,000s real quick, but if we just kind of drag along bottom for a while, which wouldn't be insane given the devastation that happened in the economy, the financial crisis, and so on, then I go with Charles's trading range analogy. The thing is, I'm not clear what it is. Is that what's going to happen, or will it be just a slow, steady recovery? I don't believe that the current market level, and I kind of disagree with Charles here, I don't think the current market level is people expecting a V-shaped recovery. Okay? I mean, yes, it rocketed off 6,500, but as Kevin has pointed out a number of times, that's from being way oversold. Okay, and so now being at around 9,000 when the market started the year at 8,770, something like that, right? That's not crazy. If we start to push well beyond 10,000, the fundamentals don't support that. I'd say right now that where the market's at is about what people expect is a slow, steady recovery. We were hoping that it could pick up speed and that was what would fuel us higher. We got to pause out here for a while and see what the economic numbers and third quarter earnings start telling folks before I think we can make any serious advance from here.
All right, and that's the latest from here. Check back often to get updates on what these people feel is going on with the market and with the economy and how that might affect you. With everybody here, I'm Terry Ruffalo.